All right, let's dive right into this explainer. Welcome. If you are a business leader, a supply chain executive, or an infrastructure investor, you are exactly who this briefing is built for. Today, we're unpacking the high-level strategic reality of the 2026 global EV market, pulling our insights directly from the International Energy Agency's brand new Global EV Outlook. And look, we're not just going to count how many cars are being sold, you already know those numbers. We're looking at market stability, the macroeconomic crush of this new energy crisis, and what it all literally means for your long-term investment in manufacturing strategies. So, let's get into it. Now, taking a look at this, the sheer physical scale of the global auto trade is just wild, right? But here's the thing. We're currently navigating an unprecedented energy shock, right alongside some really massive shifts in cross-border trade dynamics. As a leader, seeing a logistical footprint this huge should immediately set off alarm bells about supply chain resilience. This whole interconnected beast is reacting to a volatile energy market in real time, and the EV transition, it is sitting dead center in the eye of that storm. Okay, keeping things tight, here is our agenda for today. First, we'll hit the energy crisis catalyst. 2, supply chain and mineral risks. 3, infrastructure and grid bottlenecks. 4, charging investment realities. And finally, number 5, future deployment scenarios. Let's kick things off with Section 1, the energy crisis catalyst, focusing on oil markets and EV sales growth. Check out this number. In 2025 alone, the global EV fleet avoided the consumption of about 1.7 million barrels of oil every single day. 1.7 million. That is a staggering volume of energy demand just completely wiped off the oil markets. Now, this was primarily driven by places with strict fuel economy and CO2 standards like China and the EU. But the big takeaway here? EVs aren't just a green initiative anymore. They're actively functioning as a massive macroeconomic buffer, seriously reducing national and corporate dependencies on imported oil. And this regional data proves a point that any global manufacturing strategist absolutely needs to be paying attention to. Look, overall global sales dipped about 8% in the first quarter of 2026, mostly because of some specific policy shifts in the US and China. But look at the rest of the board. Adoption in other key markets absolutely exploded. Europe was up 30%. Latin America surged by 75%. And the Asia-Pacific region, excluding China, saw an insane 80% year-on-year growth. So, if you're planning international expansion, emerging markets are rapidly becoming the heavyweights of EV growth. Moving right along to Section 2, supply chain and mineral risks, and those nasty bottlenecks in production. Okay, let's look at geopolitical concentration objectively. Right now, China controls an average market share of 70% in the refining of 19 out of 20 strategic minerals. 70%. That is a staggering level of market concentration. For you as a business leader, this represents a profound supply chain risk. The problem isn't that these minerals are rare in the ground. It's the capacity to process and refine them at the breakneck speed demand is growing, all localized in one geographic area. That exposes the entire global industry to major supply security disruptions. Now, a specific major choke point in this chain is cathode precursor manufacturing. Making these requires incredibly tight control over the chemistry, particle size, and impurity levels, basically everything that dictates how the final battery actually performs. Because this intermediate step is so heavily concentrated, literally any geopolitical friction instantly ripples out to your final product. And sure, there are new processes being developed to bypass precursors entirely, but ensuring consistency and performance, that remains a massive technological hurdle. And it's not just the complex chemistry. The fundamental supply of essential foundational metals like copper is tightening up dramatically. Copper is absolutely the cornerstone of electrification. It's in the vehicles, the chargers, the grid itself. The IEA expects some serious supply tightness for copper coming up, which is already pushing prices to record highs. If you're an executive managing a manufacturing strategy, this directly threatens your profit margins across the whole ecosystem. And since it takes years to permit and develop new mines, this price pressure isn't going away anytime soon. But hey, it's not all doom and gloom. The long-term saving grace of battery minerals is their recyclability. Fossil fuels, you burn them, they're irreversibly consumed. But with batteries, we're building a circular supply chain. The data shows that by 2050, recycling could actually meet up to 20% of global lithium and nickel demand, and over 30% of cobalt demand. This completely highlights the long-term financial impacts of transitioning to sustainable manufacturing. Eventually, the pressure on primary material extraction drops because the global fleet literally becomes its own secondary mine. All right, let's pivot to Section 3, infrastructure and grid bottlenecks, focusing on upgrading the power network. Let's be real. The sequence for upgrading the grid is agonizingly slow. It all kicks off with demand forecasting, which is incredibly uncertain given how fast charging habits are shifting. Then you've got location-specific cabling requirements, which leads to wild variations in project costs. And finally, even if the technical solution is straightforward, you run smack into multi-year sourcing lead times for critical hardware. Things like transformers and high-voltage cables. Planners eat up the cheaper grid expansion options really quickly, meaning you're inevitably facing progressively higher cost upgrades as time goes on. Which leads us perfectly into Section 4, Charging Investment Realities. Let's talk IRR and project profitability. As a business leader or infrastructure investor, you have to be asking yourself, how did these bureaucratic delays actually hit my bottom line? Everyone complains about red tape, but what does that mean in actual dollars and cents for a commercial charging project? Well, according to Atlas public policy data cited in the report, the financial damage is absolutely brutal. A mere 6-month delay in permitting and grid connection wipes out roughly $104,000 in net present value for a 600-kilowatt fast-charging station. And for a larger 1-megawatt station, that same 6-month delay destroys over $165,000 in NPV. Multiply that kind of bleed across a national network, and you quickly realize that bureaucratic inefficiency is literally one of the biggest systemic risks to the entire deployment strategy. So, the crucial point is how governments choose to incentivize this build-out. Upfront CapEx grants are super popular, right? They give you great early-stage liquidity and bump your internal rate of return by about 3 percentage points. But shortening the time it takes to break ground and secure a grid connection actually brings your revenues forward. Faster permitting results in a massive 5 to 6 percentage point IRR bump. Fixing the bureaucracy is nearly twice as effective at boosting investor returns as just handing out upfront cash. Wild, right? All right, let's wrap things up with Section 5, Future Deployment Scenarios, and what your strategic planning outlook should be. Looking at this data, it's crystal clear how regulatory environments map directly to adoption rates for both light-duty and heavy commercial fleets. Let's break down the 3 distinct policy scenarios the IEA modeled and see what they actually mean for your total addressable market between now and 2035. First up is the Current Policy Scenario, or CPS. This is our conservative baseline view. It assumes essentially no new regulations, slower tech cost reductions, and that existing infrastructure constraints remain largely unresolved. Under this model, growth stays fairly subdued outside of markets with already strong frameworks. By 2035, EVs would make up about 22% of all vehicles on the road. If you're building a highly risk-averse, cautious business strategy, this is your baseline. On the flip side, we have the Stated Policies scenario, STEPS for short. This one bakes in the goals that governments have recently announced, even if they haven't fully legislated them yet. This scenario projects a massive 6-fold increase across all vehicle types. What's absolutely vital for global strategists here is that a huge chunk of this market expansion, hitting 55 million electric cars by 2035, is heavily driven by adoption in emerging markets and developing economies. In this world, EVs blow past 25% of the total global fleet, fundamentally altering global auto trade patterns forever. And for a true upper bound, we have the net zero emissions scenario. This envisions a world where global energy-related CO2 emissions hit net zero by 2050. To pull that off, it requires an incredibly aggressive push, expanding the global EV fleet to nearly 800 million vehicles within the next decade. 800 million! Achieving that would require an absolutely unprecedented mobilization of capital, virtually frictionless permitting, and a flawlessly executed global supply chain. So, based on everything we've explored today in this explainer, the massive energy crisis catalyst, the undeniable surge in regional growth, those highly concentrated mineral supply chains, and the harsh realities of grid bottlenecks, ask yourself, is your organization actually prepared? Are your supply chains secure enough and your infrastructure investments robust enough to navigate these roadblocks and capture your share of this inevitable global shift? Let that sink in as you review your strategies. Thanks so much for joining me today, and I hope this briefing gives you the strategic clarity you need moving forward.